Hey guys, Sebastian Guerra here, and welcome to Guerra Financial Tips. Today we're going to be going over the 3 different types of annuities that exist in the United States. But here's the interesting thing. Over the last 12 to 24 months, annuities have actually become one of the most lucrative, most sought out investments in the entire country. And today we're going to be going over exactly why so many people are using annuities today. You see, annuities are only set up at insurance companies. Now, there's 3 different types of annuities that we need to understand. The first is something called a fixed annuity. So how does it work? Well, now you're going to go to a company, or you're going to work with an advisor that represents dozens or maybe hundreds of companies, and they're now going to tell you, okay, we got this great fixed annuity. They're going to pay you a fixed rate of return during the time period that you purchased that annuity. So let's say that right now you said, I wanted to set up a 5-year annuity. Well, this insurance company is going to guarantee you, and they're going to lock in an interest rate for you for that 5-year period. Think of it like a CD. When you buy a CD and you set up a CD at the bank guarantees that interest rate every single year for the time period of the CD. The same exact thing works with a fixed annuity. If you now have a fixed annuity that pays you, say, 5 or 6%, well, that means that during that time period, you're guaranteed that 5 or that 6% during the time period. But once the 5 years are up, normally you have to now renew the rate. Now, the beautiful thing is that in that fixed annuity, any interest that you make, you pay no taxes on any of the growth as long as you do not withdraw the money. Whereas if you have the money in a CD and you make money on the interest in a CD, you are required to pay taxes on the money that you make, whether you take out the money or not. Now, the second type of annuity is something called a variable annuity. So how does that work? Well, now you're putting the money also as well with an insurance company, but the difference is that the money is not guaranteed to earn maybe 4 or 5 or 6% like a fixed annuity. They're going to grab your money and they're now going to put it into normally something called mutual funds. And if you don't know much about mutual funds, the basic simplicity behind it is it's pretty much the stock market. That means that the money in there, it goes up, it goes down, it goes up, it goes down. Now, yes, we understand that over time the stock market goes up, but you want to be very careful because some people that set up variable annuities, these people that are setting them up, they're choosing the wrong types of mutual funds. So if you now are choosing a bad mutual fund that's not performing well, your variable annuity might lose money over an extended period of time. Now, the other thing you have to also be very careful with a variable annuity is that some of these variable annuities have very, very, very high fees. And I've seen fees as high as 3, 4, 5%. So when you think about maybe a person that has a $1 million annuity, imagine paying 5% on $1 million in just fees. Now we're talking about over $50,000 in just fees every single year. There's mortality and expense fees, there's rider fees, there's sub-account fees, there's administrative fees, and you begin to add it all up, that can be 4 or 5%. And if your mutual fund only makes 8% and the fees are 5%, that means you're only really making 3% on your money. So be very careful whenever you're setting up these variable annuities. Now, the third type of annuity is something called an index annuity. And these have become a little bit more common over the last couple of years, and they become very, very lucrative, especially over the last 2 years. And the reason is that indexed annuities normally have what's called a floor and a cap. So what does that mean? So let's say that you have your $100,000 or maybe your $1 million inside your indexed annuity, and you have a floor of 0. What that means is if the stock market were to plummet or the S&P 500 were to plummet, then that account does not lose any money because it has a floor. It has a guarantee that your principal stays intact based on the index performance that has been selected for that annuity. So if you selected the S&P 500 and it has a floor of 0, that means that if the S&P 500 plummets this year 30 or 40%, the account does not lose a single penny. But now on the other side, there's normally a cap on the indexed annuity as well. Normally these caps, right now we're seeing them at 9, 10, 11. I've seen them as high as 12%. And what that means that is the S&P 500 goes up, say 14% for that given year, you're capped out at 12% per year. So if the S&P made 20%, you don't make 20%, you make only 12%. But if the S&P 500 goes up 8%, then you make 8%. If the S&P 500 crashes 30%, then your principal stays intact. So a lot of people now that are entering their late 50s, their 60s, their 70s, they're thinking about how do I keep my money safer without taking too much risk, and I want to have lower fees. So that's why a lot of people have gravitated more towards index annuities because it satisfies those priorities that people have, especially those entering retirement. So now the question is, which one's better? Well, you see, the answer is that it all depends based on your situation and exactly how your money is distributed. The majority of the families that we work with, they normally have a bunch of different accounts, and they don't only have money in the stock market or in fixed annuities or indexed annuities or a portfolio. They normally have money in different locations because every single one of those accounts serve a completely different purpose. So if you're an individual that's kind of debating on what type of annuity you should set up, should you even have an annuity in the first place, reach out to our firm. There are some annuities now that are giving bonuses up front that can actually pay off the penalties of other annuities that are probably underperforming. So if you're in that situation and you want to get some professional guidance, feel free to reach out to us. We're here to help. Talk to you soon.